I'm Peter Guidote, Chartered Accountant, Certified Financial Planner, and Senior Portfolio Manager. And in this video, we're going to explore how to use the FHSA in ways most people haven't even considered. So let's get started. Before we dive into the strategy, let's make sure we're clear on who can actually open an FHSA. To be eligible, you must be a Canadian resident between the ages of 18 and 71. And while it's called the First Home Savings Account, that label can be misleading. You qualify as a first-time home buyer if you haven't owned a home that you lived in as your principal residence in the current year or in the previous 4 calendar years. So in 2025, that means you must not have owned a primary residence at any point since January 1st, 2021. That's a surprisingly large group of people. Older Canadians who've gone through a divorce, long-term renters, or even those who only own investment properties may still meet the criteria. So let's look at a couple of examples to see how this plays out in real life. Let's take a look at our first example. Ed is 60 years old. He's divorced, has been renting for the past 5 years, and has no plans to buy a home again. But that doesn't mean the FHSA isn't useful. Ed opens an FHSA and gradually contributes up to the $40,000 lifetime limit, $8,000 per year for 5 years. Each contribution gives him a valuable tax deduction without using up any of his RRSP room. He also continues contributing to his RRSP as usual, 18% of earned income, less any pension adjustments, and he does so with no penalties or overlap due to his FHSA. Now here is where it gets interesting. Before turning 71, Ed transfers the full balance from his FHSA into his RRSP, entirely tax-free. This transfer to his RRSP is possible even if he has no RRSP contribution room, as it is a transfer and not a contribution. This significantly boosts his retirement savings while giving him added flexibility in managing his income and taxes as he strategically decides when and how to deplete his RRSP or eventually his RRIF. Now let's take a second example. Maria is 45 years old. She owns 3 rental properties that she manages, but she's been renting her primary residence for the past 5 years. Now, because she hasn't owned a home that she lived in during that time, she qualifies as a first-time home buyer for FHSA purposes. So Maria contributes regularly to her FHSA and receives tax deductions along the way. Now down the road, she has 2 options. She can withdraw the funds tax-free to purchase a new home to live in, or she can transfer the money into her RRSP to continue growing her retirement savings. Both choices give her significant flexibility, similar to Ed in our first example, and like Ed, enjoys the long-term financial benefits. These strategies are effective, but what makes them truly work is the combination of tax benefits and flexibility that they offer. So let's recap. FHSA contributions are tax deductible, similar to RRSPs, providing immediate tax relief. In fact, up to $40,000 in FHSA contributions means $40,000 in tax deductions, which can significantly reduce your taxable income. FHSA contributions don't reduce your available RRSP contribution room, allowing you to maximize both savings options without compromising one for the other. These deductions are in addition to your RRSP limit. No contribution room is needed. Additionally, you can later transfer the funds from your FHSA to your RRSP or RRIF tax-free, even if your RRSP is already at its limit. You would be adding the full $40,000 plus any growth into your retirement accounts without triggering any taxes. That's extra tax-deferred savings with no downsides. The tax-deferred growth continues once the funds are transferred to your RRSP, contributing to the long-term growth of your retirement savings. This flexibility makes the FHSA a powerful tool, offering advantages to both home buyers and retirement planners alike. These strategies are effective, but there are key rules and time limits to consider. The FHSA must be closed after 15 years or by December 31st of the year you turn 71, whichever comes first. If the funds are unused, you must either transfer them to another account or withdraw them. Being mindful of these deadlines will help ensure you maximize the benefits of your FHSA while staying compliant with the regulations. You don't need to be young or even planning to buy a home to benefit from an FHSA. If you qualify, even unexpectedly, it could translate into thousands of dollars in tax savings and long-term growth potential for your retirement. These rules offer more flexibility than most Canadians realize, and sometimes a small shift in strategy can make a meaningful difference. If you'd like to discuss your specific situation and how the FHSA can help you get closer to your financial goals or retirement, you can book a free 30-minute strategy meeting with a member of our team. If you found this video helpful, click the like button and subscribe to our channel for more thought pieces. In the meantime, remember to be kind to yourself and to others, and I'll see you in our next video.